Cool Kids, Apple, the NASDAQ 100. This is Ken Boyd at the Accounting Accidentally Substack site. So I was not one of the cool kids in high school, although I think I was on the edge. Maybe I had my foot in the door. The idea of cool kids explains a big issue that's going on with stock investing, which I'll get to in a minute. I had my share of cool kid friends, but I was not in the inner circle, not always invited to the cool kid parties. My high school class, pretty big, 485 people, and I'd count about 35 to 40 as cool kids, so about 10% cool kids. So how does that relate to what's going on with the NASDAQ 100? Let's define it first. NASDAQ 100 is a stock index made up of 101 equity securities issued by 100 of the largest non-financial companies listed on the NASDAQ stock exchange. It is a modified capitalization weighted index, so we'll break that down. What's in the index? What kind of stocks? It includes stocks from a variety of industries, including industrial, tech, retail, telecom, biotech. You'll see other names. And as of this writing, 7/20/23, the index is up 37% year to date, which is great. But hang on, because the other thing we should know, according to CNBC, is that the three biggest names account for more than 30% of the index combined. Wow. At the moment, specifically, Microsoft and Apple are both over 12% of the total value of the index. They're truly the stock market cool kids. So how does this happen? Well, the big tech stocks generate huge revenue and profits. More investors buy the stocks, and the total market capitalization, which is the number of shares outstanding times the share price, becomes massive. So the result, these high performers become the biggest percentage of the index. Not surprising. So why does stock diversification matter? So what's wrong with getting big returns out of just a few stocks? The problem is that the few large stocks could also produce the bulk of the losses. The reason you own an index fund, which is a fund that mirrors the index like the NASDAQ 100, is to benefit from diversification. So if a retail stock declines due to bad news, you own lots of stocks in other industries, so you're not hurt as much. So what do you do now? Well, the good news is NASDAQ is rebalancing the index to provide more diversification. A quote from CNBC, NASDAQ said a special rebalance can be used to address overconcentration in the index by redistributing the weights, which is a little complicated. The index is already rebalanced on a quarterly basis. So what they're going to do is say, if we have a situation where an individual company, individual stock accounts for more than 4.5% of the index, we're going to take those stocks and we're going to add them up. And if they're more than 48% of the total, so Microsoft, Apple, other stocks, we're going to rebalance. And it says that limit is designed so that the index funds tracking the NASDAQ don't run afoul of regulatory rules governing diversification. This diversification is required for registered investment companies. One more thing. As always, discuss this with a financial advisor. Ask your advisor to provide you with a list of the top 10 holdings of the fund or the index. It's in the prospectus. It's always disclosed. You'll find it on the website also, along with the percentage of the stock market value in the fund. So you get all 10 stocks. Here are the names. Here's the percentage of the total ownership of the fund. Ask questions about diversification. Don't just depend on a few cool kids. Make sure that you diversify. So that's our discussion. If you'd like other great content on accounting and finance, you can go to accountingaccidentally.substack.com. Thanks.